Hey there, gold enthusiasts! Welcome back to our channel. Today, we're diving into a topic that's been making headlines lately. The gold market scandal involving JPMorgan traders. If you're not up to speed on what's been happening, don't worry, we've got you covered. In this video, we'll be exploring the details of this scandal, discussing its potential impact on the gold market, and exploring some of the wider implications for the financial industry as a whole. So sit back, relax, and let's dive into the world of gold market scandals. So first, we have to know what happened and how did it come to light. So, in 2020, it was revealed that several JPMorgan traders had engaged in illegal gold market manipulation. The traders were accused of spoofing, a technique where large orders are placed with no intention of executing them in order to artificially move the price of gold and profit from the resulting price movements. The Department of Justice launched an investigation into the matter, and in September 2020, 3 traders were charged with racketeering, wire fraud, and spoofing. One of the traders pleaded guilty to the charges and agreed to cooperate with the investigation. But how did this scandal come to light? It turns out that the Commodity Futures Trading Commission, CFTC, had been investigating JPMorgan for several years prior to the charges being filed. The CFTC found evidence of widespread spoofing in the gold and other precious metals markets. And in 2019, JPMorgan agreed to pay a $920 million fine to settle the case. However, the criminal charges against the traders were a separate matter, and it wasn't until the DOJ got involved that the full extent of the scandal was revealed. Don't forget to check out the link in the video description for more information on today's topic. We've included some helpful resources to help you dive deeper into the world of finance and investing, so be sure to give it a click and explore what's there. Although the gold market manipulation is not a new phenomenon, and in fact, it has a long and storied history. Let's take a trip back in time. One of the most famous examples of gold market manipulation occurred in the late 19th century, when the U.S. government was trying to maintain the value of the dollar. At the time, the value of the dollar was tied to the price of gold, so the government needed to keep the price of gold stable in order to prevent the dollar from losing value. To do this, the government would buy and sell gold on the open market, often using agents to make large trades in order to influence the price. This practice became known as the gold corner, and it worked for a time, until other traders caught on and began to manipulate the market as well. Eventually, the government was forced to abandon the gold corner and allow the market to operate freely. Moving forward to the 20th century, gold market manipulation continued to be a problem. In the 1960s and 70s, the London Gold Pool was formed to keep the price of gold below $35 per ounce in order to support the US dollar. However, the pool was unable to keep up with the demand for gold, and by 1971, the U.S. government was forced to abandon the gold standard altogether. Fast forward to today, and gold market manipulation is still a concern. In addition to the recent JPMorgan scandal, there have been allegations of manipulation by other banks and traders as well. However, regulators have become more vigilant in recent years, and there have been efforts to improve transparency and oversight in the gold market. Now let's get back to the JPMorgan gold market scandal. You guys might have a question that, what impact will the JPMorgan scandal have on the global gold market and its participants? Well, the JPMorgan gold market scandal has rocked the financial world. First of all, it's worth noting that JPMorgan is one of the largest players in the gold market, with a significant presence in the physical gold market as well as in gold derivatives trading. The actions of the rogue traders who engaged in illegal market manipulation have damaged investor confidence in the market, and many are calling for tighter regulations to prevent similar incidents from happening in the future. One potential impact of the JPMorgan scandal is a reduction in liquidity in the gold market. Investors may be hesitant to trade with JPMorgan or other large players, and this could result in a decrease in overall trading volume. This, in turn, could lead to increased volatility in the market, as small changes in demand or supply can have a larger impact on the price of gold when trading volume is low. If you're enjoying this video and finding it helpful, we would really appreciate it if you could take a moment to hit the like button and subscribe to our channel. Another potential impact is increased scrutiny from regulators. The Department of Justice has already brought criminal charges against several JPMorgan traders, and other regulators may follow suit. This could result in increased oversight and regulation of the gold market, which could help to prevent future incidents of market manipulation. Finally, the JPMorgan scandal could have wider implications for the financial industry as a whole. The scandal has once again highlighted the potential for illegal activity in financial markets, and this could lead to increased calls for tighter regulation and oversight in other markets as well. The JPMorgan gold market scandal has raised a lot of questions about accountability and responsibility. Should JPMorgan be held accountable for the actions of its traders, or is this simply a case of rogue employees? It's the same as people raised questions after the Harshad Mehta 1992 scandal. First of all, it's important to note that JPMorgan has already paid significant fines for its involvement in the gold market manipulation. In 2020, the bank agreed to pay $920 million to settle charges brought by US and UK regulators. However, some argue that this is not enough, and that the bank should be held responsible for the actions of its traders. On the one hand, those who argue that JPMorgan should be held accountable point to the fact that the bank had a culture of risk-taking and aggressive trading that may have encouraged the traders to engage in illegal activity. They argue that the bank should have been more vigilant in monitoring the actions of its employees, and that it bears ultimate responsibility for any illegal activity that occurred. On the other hand, those who argue that JPMorgan is not responsible point to the fact that the traders involved were acting on their own and were not following the bank's policies or procedures. They argue that the bank cannot be held responsible for the actions of rogue employees who went against the bank's code of conduct. So, what's the verdict? Ultimately, it's up to regulators and the legal system to determine whether JPMorgan should be held accountable for the actions of its traders. However, it's clear that this scandal has raised important questions about the responsibility of banks for the actions of their employees and has highlighted the need for greater oversight and regulation in the financial industry. But it's worth noting that there are already regulations in place to prevent market manipulation in the gold market. For example, the Commodity Exchange Act, CEA, and the Dodd-Frank Wall Street Reform and Consumer Protection Act both prohibit market manipulation and provide for civil and criminal penalties for violators. However, some argue that these regulations are not sufficient to prevent future incidents of market manipulation. They point to the fact that the JPMorgan scandal occurred despite these regulations and call for tighter oversight and stricter penalties for violators. In addition to JPMorgan, there may be other players involved in the gold market scandal. Regulators are currently investigating several other banks and financial institutions for their involvement in the manipulation of gold prices. The implications of this scandal could be far-reaching, as it could undermine investor confidence in the gold market as a whole. So, how will the JPMorgan scandal affect investor confidence in the gold market, and what steps can be taken to restore trust? In the short term, there may be some uncertainty and volatility in the market as investors digest the news of the scandal. However, in the long term, it's important to note that gold is still a valuable and widely traded commodity, and there will always be demand for it. To restore trust in the gold market, regulators may need to take a more proactive role in ensuring that market participants are adhering to regulations and that any violations are promptly addressed. It's also important for investors to do their own due diligence and carefully evaluate the risks and benefits of investing in the gold market. Thank you for watching this video on the JPMorgan gold market scandal and the role of regulation in preventing future incidents of market manipulation. If you found this video informative and engaging, please don't forget to hit the like button and subscribe to our channel for more content on finance and investing. In our next video, we'll be taking a closer look at the volatile history of gold in the stock market. From the California gold rush to the global financial crisis, gold has seen its fair share of ups and downs. So, if you're interested in learning more about the fascinating history of this precious metal and how it has impacted the world of finance, be sure to tune in.